Ladies and gentlemen, a good afternoon to you while the last few people take their seats. Thank you for joining this session, both those in the audience here and those joining us via the web streaming facility. For those who don't know me, my name's Francois Barker. I'm the partner at the head of Evershed Sutherland's pensions practice, and I'm a member of the DC Council at the PLSA. My job today is the very easy one of chairing two excellent speakers talking to us about ESG risks in DC default funds. So first up, we have Doug Morrow. Doug is an Associate Director at Sustainalytics, investment advisory firm specialising in ESG. He is the author of this PLSA paper, which you can get on the stand downstairs, all about ESG risks in default funds, and he'll give us a quick stop tour of that in a moment. Following Doug will be Mark Thompson, who is Chief Investment Officer at HSBC Bank Pensions Trust in the UK. That is a £30 billion hybrid fund, of which the DC element is £3 billion. Mark and his team have been something of a first mover in terms of recognising and managing ESG risk in the DC default fund, and he will tell you a little bit about that in a minute. Just a word of warning, if you have a smartphone and you have the app loaded up, you are going to need it in a minute. You don't come in here and just go on receive mode. You will need to actively participate. So you might like to fire that up for a question, two questions I'm going to ask you in just a minute before handing over to Doug. In terms of Q&As, they will be very welcome. I'm going to suggest we hear the two talks as a pair. Doug will set the general scene, Mark will give you a specific example, and then questions will be very welcome, and we will endeavour to leave at least a few minutes at the end for that. Again, web streaming users can fire their questions to me via the service. For those in the audience, if you see me fiddling with an iPad, I'm not on Facebook, I'm not doing my internet shopping, I'm trying to do my chair's job of making sure web stream users also get their questions asked. So, talking of questions, couple for you. And we're going to come back to these at the end and see if our speakers have managed to change your mind on anything. So first up, which of these do you think are the main ESG risks that you need to factor in when investing pension scheme assets? I've put 4 up there. I'm going to give you 10 to 15 seconds to vote via your smartphone apps. So if you could choose and vote now, that would be great. Last couple of seconds. Should be on the questions. Right, I tell you what. Have you got it? Thank you. Go to schedule, click on the session, questions in there. Sorry, I assumed everyone was familiar. Have you now got the question? No? So I've turned my phone off because otherwise it will interfere with my mic. So I can't help you, I'm afraid. Yes? Why don't you do that, James?
Okay, ladies and gentlemen, good afternoon. I'm James Wilson, PLSA staff. Not the IT expert, but I do know. You get the app and you go to the schedule. Yes, and then you find the stream session 2 tab. Yes, all with me? And then you should be able to find the DC session 2. And you can get that page and then scroll quite a long way down. You get LIFECYCLE. Yes, and you'll get DC session 2, question 1. Then you're in business. Yes?
James, you've missed your vocation in life. If pensions ever gives up, then you know what you need to do. IT expert. Right, so do we have at least a selection of people who have managed to find that on their smartphones? Yeah, good. So if you haven't already voted, please vote. That would be great. I was about to resort to a show of hands. I'm going to give you 2 seconds more. And I'm going to close this one now. And can we see the results, please? Okay. So about 50%, just over, on energy and emissions, and then human capital following with 30. The other two are trailing. Come back to that at the end and just see if we've changed anybody's mind. Okay, question 2. This one. How consistent is it, do you believe, for pension scheme trustees to invest with ESG factors in mind, bearing in mind their fiduciary duties? Simple binary, yes or no. Is it consistent or isn't it? 10 seconds to vote. And whatever you do, keep that page open on your phones so we don't need to call upon James later on. Okay, I'll close that vote. Can we have a show of hands, a show of votes, please, for that? Okay, 90% say yes. We'll see if we can convince any of the 10% naysayers by the end of the sessions. Okay, thank you for bearing with me on that. Without further ado, let me hand over to Doug Morrow. Please join with me in welcoming Doug to the podium.
Thank you very much, Francois, and thank you everyone for coming to our session today. I know we had some competition in the DB stream, so thank you for coming. And thank you to the PLSA for the opportunity to talk to you all today about this idea of risk, ESG risk in DC default funds. You will have noticed by now that I'm not Scottish or English. You may ask why a Canadian is in fact here talking about ESG risk in UK DC schemes. And the reason is, as Francois mentioned, I wrote a paper recently for the PLSA that really drilled down and looked at this topic. So that's my connection to the UK pension fund industry. So we have a lot of material to cover, so I'll try to be as succinct as I can. In terms of a brief agenda for my talk, I want to start off just by sketching out the two main trends that really combine to form the rationale for this paper. We'll then talk a little bit about some of the key ESG risks that we see in a typical default fund, and then I'll conclude by going over briefly some of the recommendations that we put forward in the paper for DC schemes and their trustees to manage ESG issues for their members. So in many ways, the paper sits at the intersection of two really important trends taking place right now. The first, of course, is the growing importance of DC schemes in the UK's retirement landscape, but even more importantly than that is the critical role played by the default fund. Now, as many of you are no doubt aware, there's a wealth of information out there in the market showing just how important the default strategy is. According to the PLSA's own survey information, over 90% of DC scheme members are invested in their scheme's default fund. Now, behavioral economics can provide some insight into why the default fund is so popular. One of the reasons is that it helps simplify what is otherwise a complex, if not overwhelming, decision for many plan members. So this was really one of the starting points for our study, the growing importance of DC plans and the critical role of the default fund. The second motivating trend is the growing use of ESG information by investors, environmental, social, and governance information. As you can see on the slide, this shows growth in the UK's ESG market over the last couple of years. This is based on data from Eurosif. And right now, we value the market at about £1.4 trillion, and that's up from about £400 billion back in 2013. Now, for those of you who are already familiar with ESG, you'll know there's a variety of different ways that it can be integrated into an investment process. In the early days, it was all about screening out companies that met certain ethical criteria, such as tobacco manufacturers or controversial weapons companies. But in recent years, there's been tremendous evolution in the industry, as many of you know. And the main drivers that we're seeing today are, first and foremost, increasing demand from asset owners. So asset owners in the UK and elsewhere are increasingly putting ESG capabilities in their RFPs for managers. And secondly, there's a growing body of evidence showing that integrating ESG factors can actually have positive risk or return benefits. So today, these are really the primary drivers of the market. And I'll just close out by saying, of that 1.4 trillion pounds right now, about 70% of that is in institutional assets. So with those two trends in mind, what we sought to do with this paper was to take a look at which types of ESG issues are present in a typical default strategy offered by DC schemes in the UK, and then what can DC schemes really do about it in a practical sense. So what we did is we built a model portfolio. We used data from Schroeder's FTSE Defined Contribution report. For those of you who know this data set, it provides asset allocation information on the default funds of the DC schemes of the FTSE 350. So using this data, we can see that a typical default strategy right now has about 71% equity exposure. This is down from 80% actually in 2013, while fixed income and alternatives are both trending up, with fixed income at 16 and alternatives at 13. So in our model portfolio, we used market benchmarks to represent each of the equity subcomponents. We used FTSE 100 for UK equity, MSCI World for global equity, and then MSCI Emerging Markets to represent the relatively modest allocation, 4% allocation to emerging market equities. This then allowed us to determine the industry breakdown of a typical default fund. And this is really important from an ESG perspective because, like so many other risk centers, ESG risks are normally thought of on an industry by industry basis. And what we found is that in our model portfolio, there's a very significant tilt towards banks, pharmaceuticals companies, as well as oil and gas plays, food producers, and software firms. Now what this means is this has an impact on the types of ESG issues that are most prominent in a typical default strategy. So this slide really represents the culmination of our work. We call it an ESG risk map. What we did is we took the industry weights for a typical default strategy, such as the 8% for banks, 6% for pharmaceuticals, et cetera, and we distributed that percentage across the ESG issues that are most financially material for that particular industry. And what this means is that, in our view, DC schemes and their trustees should be most concerned about the issues in the upper right quadrant of this risk map, because these are issues that are financially material in a relatively large number of industries, and in industries in which a typical default fund happens to be heavily invested. And the results, to me, are actually quite interesting because as a result of the industry composition, issues such as data privacy and security, human capital, business ethics, product safety, as well as maybe more conventionally, energy and emissions, these are really the types of issues that float to the top. And I think that's interesting because perhaps for some of you here, and certainly for the market as a whole, I don't think that all these issues are necessarily top of mind for investors, even though we consider them to be the most important areas of ESG risk for default fund investors over the short run. So I want to take a little bit of time just to quickly explore some of these issues. The first is human capital. This refers to strategies for managing and ultimately retaining employees. There was a good session on human capital earlier today for those of you who may have been there. There's a growing body of evidence showing that human capital is a really increasingly important value driver for companies, but especially in knowledge-intensive industries like banking and pharmaceuticals, where there's a real premium on developing leadership pipelines and on retaining employees. Now, despite this fact, it's well known also that companies are really struggling to engage their workforces. And this in turn is having an impact on worker productivity and ultimately on shareholder return. So what we did is we took a deeper dive on one aspect of human capital, which is diversity programs. And this actually meshes well with the overarching theme of this conference, which is on diverse perspectives. Now, some of you may be surprised to learn there's actually a growing body of information and data showing that gender and ethnically diverse companies may in fact offer excess return, which I think is an interesting proposition. But what we found is that in a typical default fund, 35% of investee companies have no type of workforce diversity program at all, and only 19% have what we consider to be a really, really good program. So this would have things like diversity audits and targeted recruitment and things like that. So this just provides some analysis about how default fund investors are exposed to this issue. Secondly, data privacy and security. Again, maybe not a conventional ESG issue, but it's certainly something that our analysts are spending a lot more time looking at. I think what's interesting here is the issue has quickly evolved from something that was once the purview of only telecom and software companies, frankly, to one now that is essentially economy-wide. Essentially any industry that is managing large volumes of sensitive data, including healthcare, insurance, et cetera, are exposed to these types of risks. There was a very interesting report in the UK recently, some of you may have seen it, from Deloitte. It found that just 5% of the FTSE 100 have cybersecurity expertise on their board. So that gives one indication of potential risks. We found that only 12% of the companies in a typical default fund have what we consider to be a really good data privacy and security program. And that would include things like implementing leading data security safeguards. At the other end of the spectrum, 10% of companies in our model portfolio have no type of policy whatsoever. Now, perhaps more conventionally, if you can think back to that risk map, energy and emissions also landed in the upper right quadrant. We found that a typical default fund is significantly exposed to risks around greenhouse gas regulation, as well as energy transition through investments in, of course, fossil fuel industries, but also energy intensive industries such as mining, machinery, automobiles, and cement, and things like that. Now, I think more interestingly, oil and gas, for those of you who can think back to the industry breakdown, there's a very significant allocation to oil and gas. But we actually think that other ESG issues are more material in the short run for oil and gas companies. So what I mean by that is, of course, we all read about the growing importance of stranded assets, and this is definitely a structural problem for the industry. But we would argue that in the short run, issues such as community relations mismanagement, health and safety failings, things like that can cause immediate and significant value destruction. We saw that in the case of BP, for instance, in the Gulf of Mexico. But over time, we definitely expect this issue to increase in materiality as investor awareness continues to build, as regulatory momentum continues to advance through things like the adoption of the Paris Agreement, and perhaps most importantly, as corporate reporting continues to improve. So with all that in mind, in the next part, we looked at what can DC schemes really do about it, given these risk centers that are present in a typical default fund. Our first recommendation is that DC schemes and their trustees explore the use of passive ESG products. Now, the reason we argue for passive is simply because of the cost advantage, and as everyone knows, the charge cap of 75 bips for default funds used for automatic enrollment qualifying schemes. So that was the main rationale for recommending passive. And I think what's interesting about this is when we first crafted this recommendation back in September, October, we struggled to find evidence of it in the market. And then, as many of you know, there have been a number of announcements made in this space recently. We're going to hear about one of them later on from Mark. But clearly, this is an attractive area, the idea of marrying ESG information with conventional financial factors in a smart beta context. We definitely expect to see more of these types of announcements in the future.
Doug, that's 12.
Okay. And our second recommendation is that DC schemes and their trustees start to think about ESG risk differentials among markets. So I hope you can see on the slide here, what we found in our model is that UK equities are actually relatively well positioned relative to other markets to manage ESG risk. So as you can see on the slide, UK equity receives a score on average of 66 out of 100 in our model. This compares to 61 for global equity and 56 for emerging markets. Now, I'm not suggesting there's not room for improvement in the way UK firms manage environmental, social, and governance issues. My point is simply that relative to other markets, their performance is actually quite good. So the home country bias that we saw earlier with 25% allocation to UK equities, this is actually a good thing from an overall portfolio ESG standpoint. And lastly, we recommend that DC schemes and their trustees engage with their managers and investee companies on environmental and social issues in addition to G. Now in the UK, unlike some countries, stewardship responsibilities are already widely acknowledged to be part of an asset owner's responsibilities. This comes from PLSA survey data. In their last stewardship survey, 98% of pension funds agreed that they have stewardship responsibilities. That's up from 94% in 2014. So as most DC schemes in the UK use external managers, we recommend that they incorporate a manager's stewardship capabilities into their framework, their decision-making framework for selecting managers, and also to develop guidelines on E and S issues in addition to G for their passive or active managers to follow in exercising voting rights. So that really concludes my talk. I'll just close out by saying once again that it does, in our view, my view, it sits at the intersection of two really interesting trends: the growing use of DC schemes, the growing use of ESG information, and the growing materiality of ESG risk factors. So with that, I'll close out and pass to Mark. Well done. Thank you.
Doug, thank you very much, and thank you for keeping to time too. So next up, Mark, the floor is yours.
That was a hint, wasn't it?
But only a subtle one.
I thought I'd just start with the belief of the HSBC trustees that taking ESG risks into account is completely consistent with their fiduciary responsibility. I'm glad to see that 90% of you also agree with that, and hope we might get up to 100. I think that's consistent with what the Law Commission have said and what the pensions regulator has said. And I don't know if any of you have, and I'm talking particularly about climate change, I don't know if any of you have seen Client Earth's QC opinion that came out a couple of months ago. It's 19 pages, but the last page is the relevant bit, where it says that if a trustee board hasn't taken or considered climate risk, then they could potentially be considered not to have taken their fiduciary responsibility seriously. So it's worth reading it, Client Earth's opinion, QC opinion. But given that we believe ESG risk should be taken into account, what do we actually do about it? Well, a few things. One is that we've integrated ESG into all of our fund manager visits. We only go and see fund managers once a year, and questioning them on ESG is a big part of that process, how they incorporate it into their processes. And for any new manager that we take on, we have to be confident they have got a decent ESG process. We also adopted a climate change policy for the scheme. We did that in June 2015, before COP21. And if anybody wants to have a copy of it, then see me after. And the other thing that we found was difficult was getting enough time with the trustees to talk about these sort of issues. So we set up an ESG steering group of 4 of the trustees where we debate these issues before it goes to the main board. But everything we do with regard to ESG and climate change is all consistent with our fiduciary responsibility. What I'm really here to talk about today is how we've incorporated that specifically into our DC scheme, section rather. And I'm sure you've all seen a slide like this before. We've got 3 different lifestyles. One that goes to, assumes you're going to annuitize, one that assumes you're going to take cash, and one that assumes you're going to do drawdown. The last 10 years of each of those strategies are different. The first years are the same. So when I took it to my trustees, it's always good to go to your trustees with something that sounds clever, because it's got 1 body and 3 heads. I called it the CERBERUS strategy, after the 3-headed dog from Greek mythology, the god's Hades. I was going to call it after the 3-headed dog from Harry Potter, but that's called Fluffy, and you should never go to your trustees with a fluffy strategy. But the important point of this is the dark blue part, which is, this is all the individual funds that we use, and at the time it was 2.8 billion. 1.8 billion of that is in the Global Equity Passive Fund, because that's where most of the default money is, the lifestyles money is. So the question was, it was about a year ago, I think it was about January last year, I was sort of sitting there thinking, I must be able to do better than just investing in a global market cap index. And I had 3 ideas. I wanted to get a better risk-adjusted return. I wanted to incorporate climate change protection into the fund. This was particularly the case because we'd adopted a policy, and 60% of my members in the DC scheme are under the age of 40, and they're going to be in this fund for a long time. So I wanted to give some protection. And I also wanted to make the engagement policy of my manager better, stronger. So I had 3 ideas, and then I rang up FTSE, I rang up Legal & General with my incumbent manager, and I rang up our investment consultant, Reddington, got them into a room and said, I've got an idea. And what I'm about to tell you is the output of that idea. So the first thing, to get a better risk-adjusted return, and this has nothing to do with ESG. Rather than just invest in a market cap index, there's been lots of talk about smart beta and factor investing. So what we did, we researched a number of factors and picked 4 very well-known factors: value, low volatility, quality, and size. Equally weighted them and created an index, which we call the Balance Factor Index. And what this next slide shows is the performance of those individual factors. You can see them up there, and the dark blue line is the index. So this is the index that equally weights and rebalances every 6 months to those 4 factors. Now, the black line along the bottom is the market cap index. So anything above that black line means it's outperformed the market cap index. So you can see each of the factors are outperformed, but by combining them into an equally weighted index, I got better performance through time and less volatility. So you can see that the return compared to the all-world index for the balance factor, annualized, rather than 7.05 was 9.56, and for less volatility. So that was my first tick, a better risk-adjusted return than just investing in the market cap index. The next one was I wanted to bring in some climate change protection, but also opportunity from climate change. So what I wanted to do was dial up green exposure and dial down carbon reserves and carbon emissions. But the question is, how far do you turn those dials? If I turn those dials onto full, it would just be a green fund and incredibly volatile. So I didn't do that. So I turned them such that the tracking error, when I introduced the 3 climate change factors into the balance factor index, was 0.5% difference. So not a big tracking error for incorporating essentially protection from future climate change. In fact, over the period from 2011-ish, incorporating those factors outperformed. It was a positive to performance. But even if it had been a negative, I'd have said to my trustees we should still do it, because it's protecting, not for the next 3 months, for the next 5 years, 10 years, and for a tracking error of 0.5%. But look at the fallen on, although it's only 0.5%, it had meaningful reductions in carbon reserves. So compared to the market cap index, it was nearly 70% lower. Carbon emissions were about 30% lower, and green revenue was about 100% higher. So it had a meaningful effect, but I felt, or my trustees felt, they can incorporate these climate change protections and still be consistent with their fiduciary responsibilities. So that was the new index that FTSE launched, which has got a hell of a long name. It's the FTSE All-World Ex-Controversial Weapons Climate Balance Factor Index. Fortunately, when we launched the fund, we called it the Future World Fund, which was much smaller, much tighter. But the third objective was how to make the engagement policy of the managers better. And there were 2 things that came out at the end of this. The first one is a legal and general policy. And that is for the 90 largest companies in the 6 industries that are most affected globally by climate change, obviously oil and gas, banks, that Legal and General would write to the chairman of that company and engage with them, and after a year of engagement of saying, how are you transitioning your business to a 2-degree world, if after a year of engagement there's no plans being put in place to do that, then Legal and General will vote against the re-election of the chairman, not just for this fund, but for all 300 billion that it's got. So be more punchy about trying to get this transition to work. But for this fund, we go one step further. Don't worry about all the words. The one step further is, we would actually, though it's an index fund, we will take that stock out of the fund, even though it's in the index. So it's a meaningful message to send. Clearly, we'll adapt the fund to try and minimise the tracking error that's caused by taking that stock out, but we will take that stock out if after a year of engagement they're making no plans to transition to a 2-degree world. So that's the end of the talk. And as Doug said, I'm not necessarily advocating you should do exactly what we've done. I mean, Nest has come out with another variant. I'm just pleased that the market is growing. But this last slide, it was a very powerful slide, it was to me, and it's one that builds. This shows, on a monthly basis, how average global temperatures have risen since 1850. The wider it gets, the higher the average temperature. So when you've watched that, yeah, I'm going to ask you two questions. And you haven't got to do it on your iPad. You know, yeah. Just think about it. One is, do you think global warming is happening? And if you do, what mitigants are you taking into account in your portfolios? That's it.
Mark, thank you. So fantastic timing again, thank you both, which leaves us some time for questions. Can I have any arms in the audience? Somebody at the back, and then one at the front here, and then one in the middle. So at the back first, please. Oh, no, ignore Richard. Just go, just go. You're fourth, all right?
If you're lucky.
Thank you. Steve Charlton from Vanguard. Question for Mark. Really interesting concept, and I was just interested to know what the price differential that Legal & General charged for all of the extra overlays, considering that the MSCI Global Index is probably a very low-cost commodity. How much extra does it cost to build this in?
I can't tell you what I pay Legal & General, because in a sense it was me working with Legal & General that got this product. And so, just so we're clear, they've launched the fund called the Future World Fund. We've put at 1.8, nearly 2 billion of our DC money in it. And actually, this isn't public yet, but it can be now. Yeah, we're about to put 2 billion of our DB money into it as well. So it'll be a £4 billion fund. I think the fees for this will be higher than a pure traditional passive fund, but a lot lower than an active fund. So I think it still fits very neatly within a charge cap type environment, which is the important bit. And clearly it depends how much you give them as to what fee you pay. So, and I'm not here to advertise for Legal & General.
There's a question down at the front, please. No, because we're web streamed. It's important
I see.
it goes
Okay.
through the mic.
Emma Cosworth. I write the blog of the responsiblecapitalist.com. I read a report recently which was very interesting, which was written by two senior advisors to the World Bank, which said that agriculture accounts for about 51% of greenhouse gas emissions. And yet a lot of the work that we've done so far to combat climate has focused very specifically on energy. If we turned off everything today that required energy, we would still exceed 2 degrees warming based on the COP agreements. How is it that the investment industry is yet to focus on agriculture to the degree that it needs to be focused on? And are you seeing any encouraging signs in your experience that this is an industry where we are now going to see meaningful change?
Doug, perhaps first.
Yeah, I can take a crack at that. We wrote a piece on this recently talking about how agriculture is kind of the forgotten industry when it comes to thinking about contributions to climate change. I think one of the barriers, though, is if you look under the hood at what's actually generating a lot of the emissions, it's small-scale farming and private farmers who are kind of outside the realm of the ability of investors to engage with, if that makes sense. So I think that's one barrier. But yeah, I would fully support what you said, that we need to see much more action, in terms of minimizing emissions from the agricultural sector.
Maybe I'll talk slightly more generally. One of the things that I was very keen about when we set this fund up is that we put in mechanisms that it will evolve, because there'll be more things we'd want to do. But if you wait till you've got everything perfect, you never start. You know? So we've set up an advisory committee to the fund, and there are two academics on it. One of them is Andreas Höpfner from the Henley Business School, and we're also very lucky that we've got Lord Stern from the LSE is on it as well. So I think this will evolve, yeah, and it may evolve in other ways beyond what you say as well. So.
I think there was a gentleman in the white shirt first. No, you're fourth, Richard. Gentleman here in the white shirt. Then Richard, then you, sir. That comment echoes one in the plenary session yesterday about best being the victim, best being the enemy of better. You've got to start somewhere.
Be better.
Yeah. So.
Yeah, so Ian Kelson at T. Rowe Price. So in the interests of sort of providing a challenge to the view, so you've sort of both, I think, said that ESG risk factors lead to favourable risk-return outcomes, I think. I'd be curious to see the evidence of that and just know a little bit more about what time period it covers and just how robust the analysis is. And secondly, if the evidence is maybe somewhat less than clear-cut, then are you also making a case that this is sort of good practice from a trustee standpoint, or is it fiduciary responsible, a fiduciary responsible act to trade off some member return for feeling that we're being more ESG responsible? If that makes sense.
Do you want to go first? It has to be fairly quick because we've got a couple more questions lined up.
Well, in truth, I've looked at this closely, and the academic and practitioner evidence is mixed. I don't think it's the case unequivocally that ESG outperforms, otherwise everyone would be doing it. I think what can be said, though, is that there's market consensus that it is not value destroying. In other words, it doesn't necessarily harm returns, but there's certainly no guarantee of alpha, far from it. But I would also say, just given the way the world is changing and the impacts of climate change and water scarcity are intensifying, I expect that the prospect of outperformance, the probability will increase going forward.
I suppose you could argue that now that we have Donald Trump, you might be going in reverse, and those companies that have been sort of behaving badly will perform better. They've clearly performed well in the stock market already. So if you've been too ESG centric, you might have left some returns on the table. But
very quick comment from you, Mark, and we're going to have to move on.
I think measurement's really tricky, but part of it is I'm pretty confident the next 20 years will be different to the last. So if I wait until the evidence has happened, it'll be too late.
Okay, Richard. All right, gentleman at the front. A quick question, if I can ask you, sir.
Super quick, just a comment on the last thing. Trump will be there 4 years. Climate change might be a bit longer. But in relation to just your comment, Mark, on the you said your members were under 40 years of age. A lot of your members were. I was wondering, with this project, was it top down or was it bottom up? Did you seek engagement from them on this strategy? And also, it's very difficult to get DC members engaged. And is this in some way maybe reflective of getting them more engaged rather than on ethereal things like pension returns, but actually on something that they feel is very significant for them?
This was totally top-down in the sense that the trustees believed this was the right thing to do from a fiduciary and return point of view. However, I think you're right. I think that this fund will generate more interest in the millennials, and I'm hoping that will get them more interested in pensions generally.
Right, very quickly. You've got about 10 seconds to ask it and about 10 seconds to respond, and then we're going to go back and finish off with my two questions.
Ed Evers from Investec. How much is this showing that equity is the low-hanging fruit? Are there other asset classes where this is going to be possible as well, do you think? Is that the next stage?
Equity is the obvious place to start, and yes, there's more to come. Quick.
And that was very good. Doug?
Yeah, we're increasingly seeing application in fixed income and even in alternatives as well.
Okay, I'm going to call a halt to questions, if I may. Can I take you back to your voting apps just for the last 30 seconds? I'm sorry I had to draw questions to a close. Lots going on. Thank you for your input. I want to go back and just ask these questions again and see if we've changed anybody's mind. So, which is the most important? I accept that's a bit of a subtle question. The most ESG factor, most important ESG factor. Last couple of seconds to vote. We had 54 for energy and 30 for human capital. Can we see the results? Okay, so more people now in the human capital camp and slightly fewer in the energy and emissions, and I think product safety has ticked up as well. So, interesting. Slightly bigger spread, which is what we were expecting. Second question, is it or isn't it consistent with fiduciary duties? We had 10% of naysayers, you may remember last time. Have we managed to convince any of you to vote with the yeses? Can we see the results, please? There we go. And that was
No, we'd cut it off before then.
It's still a win for the yes, and it wasn't rehearsed. Can I just thank you all for attending? Can I thank web streaming viewers for attending? And can I ask you to thank our two excellent speakers? Next up is the next stream session. You have about 3.5 minutes to get there. Good luck. Thank you very much.